Hey investor friends, I'm Michelle Marki, and in my YouTube channel, I strive to help us become better prepared for retirement and investing. And I think you're never too young to prepare for retirement. So with that in mind, I've been culling through some of my older Wall Street Journal articles, and one of them I came across from July 2023 about a very unpopular subject, at least as far as I know, among the younger crowd, called annuities. And an annuity is an insurance contract you can buy to provide a steady income, kind of like a pension, but it's something that you're paying for instead of, say, a company that you work for. So the specific kind of annuity that I came across in this Wall Street Journal article has to do with what's called a Qualified Longevity Annuity Contract, or QLAC for short. And I know that's a mouthful, so you'll probably hear me say that a few more times. But if you're like many Americans, you could be worried about running out of your retirement savings in your old age, and a QLAC will help you maybe avoid having your money run out if you can think ahead of time and maybe invest in the sort of annuity contract. So if you're also into preparing toward retirement, please be sure to like and subscribe to my video and YouTube channel, and I'll explain to you what this QLAC is all about in this Wall Street Journal article saying a little known tax break helps retirees. So if you think about what this Qualified Longevity Annuity Contract is all about, it's to help you when you're really up there. So starting when you're in your 60s or 70s, you might want to consider buying into a QLAC because it's a tax advantage annuity where it helps reduce this burden you might have when you do required minimum distributions from, say, your IRA. And that can be helpful to some retirees if they don't want to take out all of their money as part of doing an RMD, and they kind of want to defer some of that payout to later through this QLAC. So you could benefit by reducing your taxable income in retirement while also having some savings and a steady payout. Let's say when you're 80 or 85, that's where you could have an advantage with this QLAC. But one of the immediate drawbacks would be if you, say, had an emergency and you needed that money a little sooner, you wouldn't be able to use that money that you devoted toward buying the QLAC. So just keep that in mind if you may be considering committing to this Qualified Longevity Annuity Contract. So with the QLAC, some of the pros and cons are covered in this article, and I'll tell you a little bit of some of my takeaways after having read this a couple of times, which include how, let's say you want to get this QLAC and it could help you prepare for the uncertainty of life expectancy, because this article also mentions that, let's say you're a healthy female at age 65, you have about a 54% chance of living to age 90. And apparently financial advisors say that people underestimate how long they're going to live. And you also potentially would have a 31% chance of living to 95 and a 13% chance of living to 100, according to the Actuaries Longevity Illustrator. And to put a QLAC into context of, say, a retired couple in their late 70s, one couple put about $108,000 toward a QLAC because the man was 79 and the wife was 76. And the man took this $108K out of his IRA and used that to buy a QLAC with the option of having what's called a death benefit, where if you pass away before you get to enjoy the full benefits of the QLAC, then the remaining money could go to your spouse or your beneficiaries like your children. So there are some benefits, but that also has some pros and cons. So what would happen with this couple that buys the $108,000 QLAC is that they would start getting payouts of nearly $16,000 a year when the man turns 85. And that means he would avoid more than $20,000 in taxable distributions from his IRA over the next few years. And if he and his wife were to die before the payouts reach $108,000, their 4 daughters would get the difference. So that's somewhat of a perk, but just keep in mind, if you do decide to go for a death benefit, you might get less of a payout. So as another example, let's say you're 65 or 75. There's a couple of more examples of what you could potentially do. So let's say you get the maximum QLAC that you can pay for of $200,000 worth that you take out of your retirement balance. Either that, the maximum is $200K, or 25% of your IRA, whichever is lower according to the IRS. And that $200K was the same in 2023 as it is for 2024. So what you would do if you're 65 is, let's say you buy the $200,000 QLAC without a death benefit. That would start giving you monthly payouts of about $11,175 at age 85, according to MetLife. And that's a total of $134,100 in the first year. And a 75-year-old buyer would get just over $7,000 a month, or about $84,000 in the first year. However, if you were to add a death benefit to the annuity, that would reduce the monthly payouts to about $8,700 for a 65-year-old, or $5,200 for a 75-year-old. And when I did the math, the difference is about a total of almost $30,000 for the 65-year-old and about $22,000 for the 75-year-old if you were to include the death benefit. So you have to decide what is more worth it based on the math you have to do in your personal life situation. Nobody can tell you if you should or shouldn't have a death benefit component of this, but it may be something worthwhile to consider is, do you want the insurance company to get the rest of your money if you don't get to live to 85 by the time you want to get the rest of those payouts? So do you want it to go to maybe your beneficiaries, or do you want it to go back to the insurance company in exchange for getting more of a payout now, assuming you live to ages like 80 or 85? So that's a bit of a judgment call that you're going to have to make. But it's a little bit, to me, a question of, do I really want the insurance company to keep my hard-earned money? That would be the question I would personally ask myself and my future family, let's say. So I think that's definitely something to keep in mind. And the emphasis on the benefit here, as far as being tax advantaged, is there's a thing called a required minimum distribution that for everybody born 1950 and later, at age 73, they have to start taking out some portion of the money they have in an IRA or 401k, and you can reduce your taxable income by using some of the money in your IRA to buy a QLAC instead of, say, getting the RMD, some of that in age 73. So you could defer getting paid out. Instead of being paid out at 73, let's say you want to be paid out at 85. This could help you avoid some of those income taxes right now when you're 73. But starting in the year 2033, the RMD minimum age that you have to start getting the payouts would be at 75 from your 401k or IRA. So you have to keep that in mind for people who are born in 1958 or later. In the year 2033, you're going to face that RMD question. So around maybe when you're in your 60s, you can decide, would I rather pay some income taxes on my RMD distributions at that age, or do I want to route some of that money in my IRA toward this QLAC deal? So that could be a potentially beneficial thing if you think you're going to live a long time, and if you're worried that you may not have enough retirement savings when you're in your 80s, let's say. So definitely a few scenarios to evaluate here and see if they're useful to you and your family situation. So definitely talk it over with the people you care about in your life, and just trying to see if there's anything that's also useful or advantageous. You could see that if you direct this money toward the annuity, it's no longer in your retirement account like an IRA or 401k, so you don't have to withdraw as much from those accounts every year to meet the required minimum distributions. So for example, if you had a $1 million IRA and buy a $200,000 QLAC, your RMD would then be based on an $800K balance remaining in your IRA. So keep that in mind. And this QLAC is still kind of a niche insurance product. Apparently sales were about $234 million in 2022, according to the industry group LIMRA. But the market is considerably larger, and Americans currently have about $22 trillion in retirement accounts, according to the Investment Company Institute, and that's something to also keep in mind. So what a wealth advisor said is that the point is you are transferring the market risk to the insurer, and if you're healthy and won't need all of your required distributions at the start of retirement, QLACs could potentially be a good bet, especially for women, according to this advisor, compared to, say, you could potentially want to put that same money into stocks, like a lot of retirees are currently doing. They're increasingly favoring having more of their money in stocks. And that's not a surprising trend, because in recent years, before the Fed started hiking interest rates, a lot of people weren't getting much returns from bonds. So a lot of retirees have had to shift more of their investments into stocks. So even though you could do that and put your money into stocks, this advisor is suggesting that they may not see the value of the cash flow that this is going to provide for your life later in age. So instead of trying to kind of guess if your stocks will grow, because that's a little bit of a toss-up, like you hope you're making the right decisions when you invest in stocks, but they don't always go up forever. Sometimes they go down in a market crash. So the total value financially of your balance in a stock could go up or down depending on where the market is, whereas this annuity contract is giving you some sort of guarantee. And places that you can look for in these would be if your 401k or IRA were to provide these qualified longevity annuity contract options. So check with them, or also in Fidelity. They have about 5 listed in their marketplace. So definitely call up Fidelity if you're interested, or look around with some of your brokers. What options might they offer if they give you some insurers that potentially could be reputable and trustworthy? You definitely have to look into that, because I haven't looked that far. I'm just going off of what I read in this article. So if you found this video helpful or learned about something new that maybe is something worthwhile to consider, I hope you'll like my video and subscribe to my YouTube channel if you haven't already. And if you have questions, please feel free to share them in the comments. I'd love to research this annuity contract further and try to give both you and I more insights if it's interesting. And yeah, let me know what you think. I'd love to hear from you, and good luck toward retirement investing. Till next time.